you are looking to invest passively in real estate and you're wondering, how do I do this safely? Well, there are 5 ways that people lose money when they invest in syndications. And we're going to go through this with you right now.
Hi, accredited investors. Hey, I'm so excited. We got a new deal right now. It's a 46-unit building, brick, solid brick, in the race horse capital of the world, Lexington, Kentucky. Rents on this thing, they're 15% below what the market rate is around it. I know because we own several buildings in the area. We're buying this one 15% less. To learn more, all you have to do is go to homeinvest.com or click on the description down below. Inside the description, you'll see a link down there. Remember, always consult with a tax advisor, a financial planner, or attorney before making any investment decisions. Having said all that, all you have to do is go to homeinvest.com or click on the link that you'll find down in the description down below. Thanks, God bless. Enjoy the show.
If you're new to our world, my name is Steve Warner. I'm the Chief Revenue Officer. I'm joined today by Nate Armstrong. He is the CEO and founder of Home Invest. We have millions of dollars in syndications. We've both been investors for more than 20 years. What we're going to share with you right now is literally the difference between being in a successful passive real estate investment that will lead to a doubling of your wealth over and over and over again, cutting 20 years or more off your retirement curve and bringing your tax liabilities to zero and losing all of your money. That's the difference of what we are about to share with you. All right, Nate. So we're going to jump in. What is the first big way that people lose money when they are looking at syndications?
Yeah, they jump into a deal that they don't understand the debt structure, DEBT, debt. And right now it's a big one, and it should be the most important. Debt should drive your decision. And listen to me carefully on this. Just because you hear or you see the syndicator or whoever's promoting the deal say, hey, we got a low interest rate loan, you should not assume that that's a good loan. Here's why. And Steve, you let me know how we should break these down. But the first thing is that usually in the commercial world, loans are not the same as residential loans. Like residential loan, Steve, you or me, we go out and we get a mortgage for a residential house. It's a 30-year fixed mortgage. Commercial loans, multifamily loans, are usually not 30 years fixed. They might amortize over 30 or 40 years, but the term is always shorter. Sometimes it's 2 years. Sometimes it's 3 years, sometimes it's 5, sometimes it's 10. And the majority of people that are taking out low interest loans, they're actually only 2-year loans. Guess what happens at the end of 2 years when they take out that low interest today, but at the end of 2 years, they can't refinance because rates are higher. Then they lose the deal. That's where we're seeing a lot of people get foreclosed on in the space right now because they did not anticipate their debt. They took out a bad debt structure.
Okay, so number one is debt structure. When you are talking to the person that's putting together the syndication, usually called the general partner or the GP, the question that you're going to want to ask for them is, what is your debt structure? How long is your loan for? What's the interest rate? And how long is it fixed? What are acceptable answers when it comes to that, Nate?
Yeah, I'll just tell you what we do here. We aim for 10 years as a fixed debt product. Like I don't want to have to worry or stress for 10 years. Why 10 years, you might say? Well, because 10 years usually will outlast any Fed interest rate cycle. So if you notice, the Federal Reserve, Jerome Powell right now, who knows who it will be in the future, but Jerome Powell, he basically is grabbing a lever saying, I'm going to kill inflation. The way that he kills inflation is by raising interest rate, raising the cost of debt. And so right now he's on that pull the lever phase, raise interest rate phase. That won't last forever. It usually never, ever does. And so 10-year window, if you're fixed and locked in for 10 years, you can usually outlast any Federal Reserve's pulling of the lever feature. And so for in this case, 10 years, I know we'll be back down into lower rate territory within 10.
Okay, so that's the first big landmine that you want to avoid, and that is bad debt. You want to make sure that you're asking the right questions there. What is the second way, Nate? What is the second thing that you want to make sure of when you're getting involved with passive real estate syndication?
Yeah, I would call it investing in the right asset class. and specifically like what is that asset itself. So the big hype the last couple of years was new construction, build new construction. And what people didn't see coming with that is that new construction, yes, it's the latest, the greatest, it's all that kind of stuff. But what they didn't see coming is that banks would be pulling the rug out from under them in the middle of the project. Nobody thought that just because a bank says yes today, no one thought that the bank would pull out and say no in the middle of the project. No one thought that investors might back out. No one thought that contractors would get in trouble and get over leveraged and then have to bail in the middle of a project. Nobody anticipated that. So you have to make sure that whatever asset class you're getting into is going to be a safe, reliable one, regardless of the economic circumstances. And I'll tell you right now, if you graded multifamily housing stock, A being your luxury, brand new waterfront type properties, B being one step down from that, C being working class, your working class housing, C assets, that is the most stable in the midst of a recession, economic good times or bad times. Your C class assets always perform financially the best in multifamily.
All right, so Nate, just a quick question around that. A lot of people are saying, well, but development seems like they're offering these huge returns, or A class seems like it's going to be fancy, and aren't the profit margins better there? Why C class?
Yeah, well, number one, the A class deals, you'll grab them, but wait till the other guy that failed on the project goes into foreclosure and then go grab it from the bank. Buy it at a 65% cost basis. Buy it for 65% of what he paid for it. Sorry, now back to your original question, like why not go chase them down? That's why. Why do we stick with our C class assets? Because number one, the tenant base, they're going to be employed in the middle of the recession. When companies do mass layoffs, as an example, we have an engineering client who he works for SpaceX. He told us, maybe I shouldn't say this publicly, I don't know, but he told us that his team, his boss has come to him saying, hey, in the next couple of months, you need to be prepared to cut 10% of your people. It's like this is SpaceX. This is a huge company, like massively, very, very well funded. They're very well capitalized, but they're being told from the top down they need to start preparing to cut people. They're going to cut at least 10% of their labor as they head into this. Who's he cutting? He's not cutting guys on the floor working. He's not cutting the guy building the rockets. He's cutting middle management. He's cutting the people that are kind of bloated in the middle. And so consequently, like that's usually where corporate America is going to cut. They're going to cut some of the salaries that are a little bit bigger. They're not going to cut the guy actually building the thing.
All right, so the second question that you want to ask when you're talking to the GP is what asset class is this? And you want to make sure that it is C class. No new development, no A class, and definitely no commercial right now. You want to make sure that it's solid C class housing. All right, Nate, that brings us to the third big question that you want to ask. What's the third way that people lose money when they are getting involved with syndications?
Yeah, but by working with someone that, and I guess I would ask it like this. I would say during the last downturn, what were you doing? Did you take any projects start to finish during the last downturn? Did you finish anything during the last downturn? Most people that are entering the syndication space, they haven't lived the cycle. We haven't seen a downturn since 2008. Do the math on that. That's not that recent ago. That's a long time ago. And a lot of people that popped into the real estate world, like maybe, I don't know where everyone's background, but a lot of people, they just have not actually been an operator, a syndicator, someone actually doing deals that long. So I would always want to interview and figure out what were they doing during the last downturn? Did they survive? Did they get crafty? Did they figure out how to cut expenses? Did they still raise income in the midst of a recession? Because I'll tell you what, we raised income during the midst of the last recession. Why? We were the best properties. We were the cleanest. We kept them the most upright. We were the best at customer service. We took care of maintenance requests promptly. Our unit stayed full and we raised rents during the last recession.
So that's the question then that you want to ask. What were you doing during the last downturn? Did you take something full cycle? Because there are a lot of people that got into this game in 2015, 16, 17. They did well but now they're struggling. They don't really know what they're doing. They don't know how to manage the properties, how to get maximum income from them, and how to keep their tenants happy. So that's the third big question that you want to ask, which brings us then to number 4. This has more to do with the actual deal. When you are looking at the deal, what is the thing that you want to look for? This is going to be our question number 4.
Yeah, let's talk fees. A big fat FEES, fees. So what are you looking for in fees? Well, number one, I want to make sure that the team that I'm choosing to partner with, the syndicator, the sponsor, manager, I want to make sure that they're getting paid fair, but I want to make sure that they're not getting fat off of one deal. I heard a story. We have an investor of ours that committed $4 million to one of our projects, and he told us why he chose us versus anybody else. And I'm like, yeah, please tell me, help me understand. And he said, well, Nate, another group that I worked with, I had paid fees. I'd paid to, put in my money and we closed on the deal. And then literally the management team disappeared right after closing. I'm like, you're kidding me. Like, what are you talking about? He's like, yeah, they just disappeared. I'm like, no way. And eventually he had to get an attorney involved and he had to take over the project. And what he found out is that the team was literally just taking the fees to close the fees out and pocketing the fees. And then they were just disappearing. Shocked me. Unbelievable. But the common denominator is that their fees were so big, they made more money on the fees than they did on the back end of the deal. So they were just incentivized to collect the fees. So what you want to look for is a team that's being reasonable. They shouldn't get rich off of the fees. They should get rich when they sell the deal or when they hit their IRR, when they hit the returns, when they fulfill the business plan. So the way that we do it internally here is that we structure all of our deals 70-30. 70% of the upside goes to our investors, 30% goes to us. We do charge a fee for acquisition. We do not charge an asset management fee. We also make the majority of our profit on the back end when you sell the deal, when you monetize it for everybody. We pay our investors first, and then we get to take our chunk of the pie. So I would look for fee structures that are favorable to back end performance for the person that's managing it.
Nate, that's a great segue into our last big landmine, the last way that people really lose money on syndication. So 4 is the fees, and you just want to ask up front, just to be clear, Nate, let's put this in perspective. What are the fees that are okay? A reasonable acquisition fee, a small marketing fee. What else goes under the fee column?
Yeah. So when you're sizing up the acquisition fee, as an example, think about like realtors, brokers. If they were out there hustling on the ground, bringing an off-market deal, how much does a realtor or broker get paid? An acquisition fee should be somewhere in that range. And it's okay if it's on the high side. It just should not exceed what a realtor would make on a deal. What about the marketing fee? Marketing, it does cost money these days. We all know it. Inflation's eating stuff alive. The other fee is sometimes legal. Attorneys do charge money. I haven't been able to get an attorney to do anything for free ever. But so those are all reasonable fees, marketing, legal, and then sometimes stabilization. If there is a larger construction effort that has to be done, such as a lift or deep renovations, then it is fair for a team to make money managing the contractors because there's a lot more on the ground. Like you got to physically be there and have an employee there. Those are all acceptable fees that I would see. I would try to avoid when you start to see heavy asset management fees. That's where they charge a fee year over year on the money. That's really common nowadays. Some is okay. We do none. We make the rest of our money on the backside. Some's okay, but if it's really aggressive, I would stay away from it. And then on the backside, this is where we're going to go to the next one. Should I talk waterfall next? Oh, wait just a second. We'll get into that one.
Just before we get into that, I just want to I'm trying to make these really clear so people can sit down and say, okay, what are your fees? Yes, that's good. Yes, that's good. No, that's not good. You want to make sure that it is back end weighted for the GP, the general partner that's putting this together. You want them to make their money on the end. Then they are going to be dedicated to have skin in the game, make sure they're managing it well, make sure they follow through on the things that they say. Not a lot of front end heavy fees. Now, it's okay to take some fees on the front. We do have a lot of costs in getting these together, and that's part of what you're paying for coming into the syndication. That's what makes it successful, but they should not be exorbitant. That does bring us to our last big landmine. This is the last way that people lose money. Nate, what is the last way that people lose money?
Yeah, bumpy waterfalls. They go for this variable waterfall scale. What is a waterfall? First off, a waterfall is how are profits divided. Once profits come in, once original capital is returned and now we're truly in the profit zone, how is that profit divided amongst people? A lot of people that are doing these deals, the promoters, the GPs, the syndicators, they do complicated structures. Sometimes they just make my head hurt when I see them. You want to run from those. Here's why. Some of the folks that are putting these deals together, they're literally, the waterfall says, hey, from X profit range to Y profit range, you get this percent. And then if we make more profit, you only get this. And then if we go take a new loan and we refinance you, you get nothing. Like, just avoid those, run from those. When you enter a partnership, the waterfall should be fixed from day number one. You're entering as partners. You're coming to a business agreement. Remember, your money is helping bring this deal to life. It should, that because you're bringing it to life on day one in its conception, it should carry forward all the way till the day you sell that asset. It should not disappear because something changes structurally later on. So stay away from complicated waterfall structures. Go with one that's a straight line all the way through from start to end.
That is the real thing here, guys. If they say, well, if it moves a little bit at the end, what that really means is when the money starts to get really good in the deal, they're going to take the majority of it and leave you with very little of it. You want to see fixed structure. So for us at Home Invest, we do 70-30. We take 30%, we give 70% to our investors, and that stays the same all the way through the deal so that you get to participate in all of the upside. It's very simple. A good rule of thumb when you're talking to the GP is if they have to start explaining stuff and they say it looks complicated, but it's really simple. Here, let me show you. Run away. All right, guys, those were the 5 big mistakes that people make when they get involved with syndications or passive real estate investing that cost them money. We don't care whether you invest with us at Home Invest or if you find another deal out there. We just want to make sure that you have a deal that performs well, helps you double your money, retire faster, and cut your taxes. If you have questions, you can hit reply to any of the emails. You can talk to us through the Facebook group. You can show up to our weekly show called the Opportunity Zone. However we can help you, Nate and I are both here to help you live out the principle of Matthew 25, which is being a great steward of what God has given you, doubling your wealth and building an inheritance for your children's children. Thanks so much. I hope this video is helpful, and we look to talk to you soon.